Hello to everyone again. This is the latest in a series of short blog type recordings that we're doing, talking about the Vermeer Global Fund and our current views of what's happening in the macro economy. This week looks to be another massive week in terms of economic news flow. We have the all-important US inflation print. The back end of last week, we had US employment, and we think as a firm, our portfolio is managed very much against our macro views. So how inflation, how interest rates are shaping up in the US, what that's doing to the dollar, all those things are very important inputs for our stock selection, reasons for why our portfolio has been defensively positioned this year, why we have cash, why most of that cash is in dollars, are all kind of framed by some of those thoughts. And Charlie, this is going to be another huge week, isn't it? Inflation print on Wednesday. We had the big unemployment data out the back end of last week. How do you sort of see all that shaping up?
Yeah, I think we're at this point now where the macro is driving the market. We're heading into earnings, and I know we're going to do a separate video on that later this week. But the macro is really driving sentiment and driving the market right now. And these upcoming prints over the next few days are going to shape, I think, how the market's going to be trading, at least in the short term. As you mentioned, we had the monthly non-farm payrolls report, which came out at the back end of last week. Overall, it was generally pretty solid on a headline basis. The job market's still growing, and none of the data that was released there, I think, is going to give the Fed any reason to press pause. I think the market's now nearly pricing in 100% certainty that they're going to hike 25 basis points at their July 75 basis points, at their July meeting later this month. And the interesting dynamics within that, though, when you look beneath the headline figures, were quite interesting in terms of the difference between what the household survey was saying on jobs versus what the establishment survey was saying, seeming to indicate on the household front they were seeing some slowdowns in jobs growth, which tends to be a bit of a leading indicator as to where the labour market's going to be over the next 3 to 6 months or so. So that's something we've got to keep an eye on. But as you said, we've got inflation data this week, we've got producer price inflation data this week, and we've also got retail sales this week. So a lot of information coming out before earnings season is to level set where the economy is. And all of these factors, with the confirmation that the Fed's likely to continue to hike aggressively over the next few months, has led to the dollar continuing its really, really strong run. And it's really seeing this differential really impacting other currency crosses, but also starting to see some impacts on other economies. Seeing the pictures coming out of Sri Lanka over the last week or so with the storming of the presidential palace, because they've got no foreign currency reserves, so they're really struggling importing fuel and food. And this dollar strength is likely to see some more impacts across that in emerging markets, as we've seen in the past. And although the dollar strength's impact on the global economy is outside of the Fed's inflation and labour market remit, it's something they really need to be paying attention to, as the strong dollar really starts to impact the rest of the world, isn't it, at the moment?
Yeah, I mean, this is a real problem. And I think, we've been dealing with interest rate hikes, fears of inflation. And, this week's inflation print is going to be, it's forecast to be 8.8% at the headline level, 5.7%, core. Some of those numbers, they are very elevated. They don't reflect the fact that the oil price has fallen and the gas price, we are seeing some benefit there in the US at petrol prices, et cetera. None of it's going to reflect that. So the headline numbers are going to look pretty ugly again. And they're going to probably, shape sentiment, because they just need to be somewhat better than the nasty headlines. And it might actually help stocks to rally a little bit. But, obviously we'll have to wait and see on that. But the dollar issue is becoming much more front and center now, because we've seen a really significant strengthening, haven't we, over the last few days. As you say, the pictures coming out of Sri Lanka are really very unpleasant for those people. And, this is going to carry on. And normally at a time like this, you would start to see intervention, maybe from the White House or the Treasury Secretary, to start trying to talk the dollar down. But, there's been a notable absence of any of that to this point. And it's very difficult to see what they can say, because without contradicting the Federal Reserve's policy to put rates up very aggressively in the short term to quell inflation, it's really difficult. What can they say? So I don't actually see how that is going to change. But at some point, You know, that's going to really worry people if that persists, because it's going to really start to impact other parts of the economy. You know, and we're in a position now, aren't we, where the dollar is, you know, looking like it's going to move to parity or very close to parity against the euro. I mean, what do you think about that?
Yeah, well, I think it's just a matter of time, really. I think everyone expects it to get there. I think there's a difference between maybe looking at where things should be trading on an economic fundamentals perspective and where we're going to end up trading, as I said, the sentiment-driven market continues. And we've seen that the rate differential between where we are in Japan, for example, and where we are in the US and where the US rates are going to go is leading to this carry trade, which is significantly weakened the yen this year, although the equity market itself has held up reasonably well comparatively to the US so far this year. As a sterling-based investor, as we are in the fund, the FX translation effect has really hurt from our Japanese positions. And we've seen some news out of Japan over the last week or so. Obviously, there was the terrible, tragic assassination of former Prime Minister Abe last week. And despite that, the LDP, his party, with the new Prime Minister, managed to gain their 2/3 supermajority within the upper house in the elections, which allows them to drive their reforms and changes that they want to make. Abe did control the largest voting faction within the party, so there is political uncertainty as to what might happen there in the future, but that's something to keep an eye on. But in terms of the agenda that can be pushed now through with the new parliament in Japan, we're looking hopefully for things like the constitutional reforms likely to come through, which probably will focus on defense spending in this new world that we live in post the Russian invasion of Ukraine, but also the push more into restarting their nuclear power plants as the world struggles with this energy shortage on the back of price rises and the curtailment of supply to certain parts of the world out of Russia. Japan's got a lot of idle nuclear facilities that have been shut down since the disasters several years ago that are ready to be turned on. And I find it personally incredibly surprising that they haven't turned them on yet, given the electricity shortages they were seeing in Tokyo over the last couple of weeks. But the turning on of nuclear power stations is not just a Japanese issue. It's something that we think should be happening in Europe and should have happened already, isn't it?
Well, you know, it does seem strange, doesn't it, that in Germany, there does not seem to be any great push to restart nuclear. And yet at this time of, you know, considerable concern over climate change, coal is being, you know, pushed again to help, you know, bridge the gap. And that does seem an astonishing turn when nuclear energy seems to be part of the European taxonomy. So I have to say, I don't really understand that. You know, there are considerable concerns heading into winter as to what the impact that might have on the German economy, where you could see a very significant weakness in GDP if you have power shortages and at a very difficult time, you know, if you have a very cold winter. So there are a lot of challenges there. And of course, you know, that has pushed this issue of how much could rates rise in Europe by comparison to the US, and is creating this gap, isn't it, between expectations of rate rises in the US and whether the Europeans will actually be able to do much more than a token gesture on rates. And that, of course, is exacerbating this dollar strength, you know, that we've talked about, and is, you know, creating a real problem for Europe. So, you know, it'll be good. The weak euro and the weak yen will be good for earnings for export-led businesses, which of course will be a negative for the US. The strength of the dollar will be a negative for their earnings going forward. And of course, in the UK, we'll be seeing a similar thing when UK companies report. The weakness of sterling, which has been a significant factor this year, will also benefit those companies who report export and dollar-based earnings, but of course won't reflect the difficulties that there are within the UK domestic economy and all the political issues that we've been having recently. So have you any thoughts particularly on the political situation in the UK, or should we leave that for next time when the picture is a bit clearer, Charlie?
Well, I think the situation changes all the time. We'll leave it to the so-called experts within the papers to see where we're going to end up on that. With 11 people running for the new leadership, it's we'll see where we are within the next 1 or 2 days as to how many of them are left. But I mean, yeah, the UK economy, it's we're, I think, struggling from just a lack of policy direction right now, as we don't know where we're going to be towards the end of the year. So that's something we just have to keep an eye on. And as you said, sterling's been weak, the euro's been weak. Ironically, with us, our office being based in London, it seems like the tourists are back in full strength. The Americans taking advantage of dollar strength to come and travel into Europe and spend some money. But I think the UK is it's going to be a watch and wait. Sterling is trading. I think it was interesting the fact that when Boris Johnson did step down, sterling did strengthen slightly. It didn't really change a lot on the dynamics around that, which I think indicates that it was already being priced in, the fact that he was going to step down. So as you said, we'll see. Any sort of policy certainty and direction, I think, can only be helpful to the UK market. But we'll see where we end up, because it changes every day.
Yeah, absolutely. And subsequent to that very temporary rally that we saw in sterling when the Prime Minister finally stepped down, that's been superseded by considerable dollar strength, which I know we've talked about a lot on this blog, but I mean, it is dominating sentiment now, and the inflation figures that we see later this week will again have a major impact probably on the direction of travel of the dollar and of other currencies. So that's going to be a very important thing to focus on. Obviously, we will record a follow-up blog talking about that post-inflation numbers, and perhaps, Charlie, you'll have a stronger view of what's happening with the 11 potential prime ministerial candidates by then, or maybe not. So we'll leave it there. Thanks very much to everyone who's tuned in. We'll be doing a blog, as Charlie said, on earnings as well as we go into that season, and keep updating you with our macro thoughts and the way that may be shifting our portfolios. But as I said earlier, the Vermeer Global Fund, which, as you know, if you've listened in before, is a long-only global equities fund, is quite macro thematically driven. We have been cautious this year. As Charlie pointed out, the difficulties of the strength of the dollar have helped in absolute but not in relative terms, particularly because of the weakness of the yen. And we continue to position defensively for the time being, because markets are very challenging with a lot of cross currents. So with that, I'll leave it there. Thank you to everyone who's tuned in, and look forward to speaking to you again soon.